the best of Money Matters. Market View on Money FM 89.3.
That's right, you're tuning into Money FM 89.3, and it's now time for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares were little moved after ending the previous session flat. So the Straits Times Index was up 0.07% at 3,834 points at about 12:26 p.m. Singapore time, with a value turnover of some 801 million Sing dollars in the broader market. But as we shared with you earlier, the STI ended in the red. So let's take you through the closing numbers. So the STI closed down 0.21% at 3,823 points. In terms of value turnover, we're looking at 1.53 billion Sing dollars. Now, gainers outnumbered losers, though, 309 versus 208. Top advances for today, we've got for you GMH USD, Hong Kong Land USD, and Prudential USD. And top decliners, we've got OCBC, SGX, and ST Engineering. Now, in terms of counters to watch, we have CapitaLand Integrated Commercial Trust after it posted net property income of 291.5 million Sing dollars for Q1 FY2025. Now, that's a 0.8% drop from the previous corresponding period. Now, elsewhere from China, reportedly considering suspending its 125% tariff on some U.S. imports, to how Singapore Airlines has partnered OpenAI to develop and execute generative AI solutions. We've got more international and corporate headlines in focus. And joining me on the line today on a Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome back.
Hi, how are you?
Good. And Ben, let's start with the Singapore stock market this time around. How did the STI fare today? Any surprises when we look at the biggest movers and the sectors that they lie in? A couple of advances with dominated in USD, it seems.
Well, sure. Yeah, well, Hong Kong Land, as you mentioned just now, is, came in at almost up 10% today. So that was a huge surprise, really on the back of news that is selling the top 9 floors of its asset, One Exchange Square, to the Hong Kong Exchange. I guess the market took it really well, because the idea here is that the recycled capital that can then be used to buy back the company's shares. So market was really excited about that, so much so that JP Morgan actually upgraded the stock from neutral to overweight. And its price target went up from $4.50 to $4.90. So the market price today went up really in response to the good news as well as the market upgrade. Now, for the rest of the STI component stocks, kind of a mixed bag, really reflecting the wider market uncertainty over the continuing tariff war as well as the global slowdown. So no surprises on those.
And zooming in on some of the counters to watch, earlier we talked about CapitaLand Integrated Commercial Trust posting their net property income of 291.5 million Sing dollars for Q1 FY2025, a 0.8% drop from the previous corresponding period. How far was that within your expectations, and how did investors react to the latest set of numbers?
Well, it wasn't too much of a surprise, because we do know that the asset 21 Collier Quay was divested in November 2024. So yes, we expected the NPI to come down a little bit. The reduction in NPI was, thankfully partially offset by rental reversions in both the REITs, retail, as well as office business lines. So for retail, rental reversion was slightly more than 10%. For office, was slightly more than 5%. So that was for Q1. Now, going forward, retail may take a hit. Really, again, is because of some potential slowdown in tenant sales because of the ongoing tariff war. So that might have a dampening effect on consumer spending. The office space is, as usual, pretty resilient, similar to what we've seen in the COVID pandemic. Companies are really taking a wait-and-see approach, so they're not drastically changing their, the amount of space they take in the office sector. So it's interesting to see that CICT actually had quite a good run in the last 12 months. So it was the total return was about 15%. But going forward, the upside potential is around 5%, simply because of the potential headwinds that we're seeing.
And another REIT to watch for today, Ben, is Suntec REIT, because its DPU, or distribution per unit, rose 3.4% from the same period a year ago to around 1.563 Singapore cents for the first quarter ended March. What do you make of the latest numbers, and how far is that in line with the results presented by its fellow peers in the REIT sector?
The risk factors for Suntec is very similar to the rest of the REIT sector, as well as CapitaLand Integrated that we spoke about just now. So again, you've got the twin business lines of the retail and office. So specifically for Suntec REIT, consumer spending again may be impacted by the tariff war, and the property Suntec is kind of mixed use, right? You've got like 3 or 4 office blocks, and then the bottom is really the shopping center. So the management has guided the retail rental reversion down to 5 to 10% from the previous 10 to 15% estimate. So that's for going forward. And again, the office space is still considered to be resilient. We have seen the first quarter rental reversion of 8%, which was slightly higher compared to its estimate of 1 to 5%. But going forward, we're probably going to see a slowdown in that, and the 1 to 5% rental reversion for the full year is probably going to be intact. Now, one thing to note about Suntec is that it's got this Australian portfolio as well. So it's Curry Street, Adelaide property. It's still continuing to see challenges simply because of new supply coming in that particular market. But all in all, the 12 months upside potential is probably going to be about 10% for 2025.
I see. And Ben, let's stay in Singapore and turn our attention to Singapore Airlines, because Singapore Airlines has partnered with ChatGPT maker OpenAI to develop and execute generative AI solutions for the carrier. Now, how significant is the move for both firms, especially for SIA when it comes down to share price movements?
In short, the market loved it. At one point, SIA was up about 2%. I think the closing numbers is that SIA is up about 1% today. Some of it is obviously a knee-jerk reaction, but because as with most companies nowadays, if you say you're doing Gen AI or ChatGPT, the market tends to react quite positively. But I think going forward, Gen AI really has got the potential to improve the efficiency in a lot of companies' back office systems, for example, like customer service, some of the financial systems like forecasting, budgets, and so forth. If you talk about Gen AI in the hospitality business, then we'll be talking about room vacancy optimization. So those kind of things, Gen AI is really good at that. Simply because for people who are not AI trained, the natural language format for both input as well as output is really, intuitive. So it's much easier for people to ask questions and then get solutions in natural language. I don't see that as being a negative in terms of new hires and employment for SIA. I think what they're going to do is probably, the headcount could be the same, but they're going to be redeploying more of their staff to more front office, customer engagement, or higher value add kind of functions, so that the more things which Gen AI can do very well, then you're going to leave it for the AI to do that. So really excited to see how this pans out for SIA. I think this is all positive news, and hopefully the knee-jerk reaction today is going to continue for the rest of 2025.
Now, if you're just tuning in, we're in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Well, Ben, the International Monetary Fund, meanwhile, has cut its GDP growth forecast for Singapore this year. Now, citing the region's exposure to the US tariff hit, as well as uncertainty from the fallout. Again, what do you make of the latest forecast given the evolving global trade situation? I suppose there appears to be some signal that tensions may ease, though we are not exactly sure if that will pan out the way that we expect it to be.
Well, to be honest, it's pretty difficult to read the tea leaves nowadays, especially if you've got some guy in a white-coloured house keeps twirling the teapot. So specifically, the IMF has lowered the Singapore's 2025 real GDP forecast from 2.5% to 2%. So you think about it, there's actually a 1/4 discount. So Singapore got off lightly. We have got a 10% direct tariffs imposed by the US. The problem is, of course, most of our trading partners, our major trading partner is, of course, the US, but most of our trading partners are in ASEAN as well as China. So you've got to check, Asia, right? And most of the countries in Asia actually face more than the baseline 10% tariff. So, we, Singapore, cannot escape the regional slowdown, and it's really hard to see when the trade tensions will ease. So there's a lot of back and forth, a lot of news flow, what the White House is saying, what China is saying, so on and so forth. So it's very much a 2 steps forward, 1 step back situation. Until we have got clarity and some kind of semblance of a normal discussion between the US and China, we do expect elevated volatility to continue.
Okay. Now, across the region, Ben, staying on the topic of US-China trade tensions as well, China's government is reportedly considering suspending its 125% tariff on some US imports, as the economic costs of the tit-for-tat trade war weigh heavily on certain industries. Now, that is, of course, according to sources familiar with the matter. So the sources said authorities are considering removing the additional levies for medical equipment and some industrial chemicals such as ethane, and are also discussing waiving the tariff for plane leases. Any thoughts on the matter, given China just came up to say that there are no active discussions, no ongoing discussions with the US on tariffs?
Not really much of a surprise. So, a little bit of color here. So China mostly imports intermediate goods from the US, in the sense that, intermediate goods go into the Chinese supply chain and China churns out finished goods and, re-exports it back to the US. So if Chinese tariffs are imposed on U.S. imports, that will obviously impact the price of Chinese finished goods. And then when China tries to re-export them to the U.S. as well as the rest of the world, that might actually make China's products uncompetitive. So it really makes sense to consider waivers for certain products and industries. And the example you brought up was some medical equipment, drugs, as well as plane leases. So if you look at pharmaceuticals, China does import a lot of, cutting-edge medicine from the West.
Yep.
So it does make sense for them to consider lowering waivers on that. For plane leases, well, the background is that China really needs literally thousands of passenger planes for the next few decades. So if you look at Airbus, there are only kind of two main companies, right? Airbus and Boeing, right? So Airbus as well as Boeing, really, they do have production backlogs, counted in the number of years. They cannot make and deliver planes to China fast enough. And if you look at China's own domestically designed and manufactured plane, it's not widely accepted yet, and it still uses engines made in the US. So really, it's not practical to exclude plane leases from Boeing. So the really smart move for China to start calibrating the tariffs so that they don't shoot themselves in the foot.
And finally, before we let you go, Ben, in the previous session in the US, results were out from Intel and, of course, Google's parent Alphabet. One reporting rather positive set of results, one reporting not very positive set of results. So, any highlights, any detail that stood out to you this time around?
Well, Intel kind of expected that the numbers are not going to go, too well, simply because they are in the midst of a restructuring. The product revenue was down 2.9% year-on-year. The foundry revenue was up 7.1% year-on-year, but that's from a relatively low base. The adjusted earnings per share was 13 cents versus 18 cents year-on-year. So that's, it's kind of a mixed bag. I think what was worse was really the Intel second quarter forecast. It was guided down. So the company now says that its adjusted earnings per share for second quarter is probably going to be around 0 versus a previous estimate of 7.2 cents. So that was really weighed on the market today. So markets, the pre-market session had really a bad sentiment on Intel, and the share price was slowed down. So, but I guess the takeaway was that restructuring is going to take time. Now, well, if you look at Alphabet actually had a really good set of first Q numbers, beat expectations on both revenue as well as earnings per share. So revenue came in at $76.5 billion versus an estimate of $75.4 billion. Earnings per share of 2.81 versus estimate of 2.01. So that was all fantastic. I think what was much better, and really for investors, was the bright spot here, was that the second quarter guidance is that the company expects its cloud demand to far surpass its data capacity. So hence justifies its $1 billion
spending
investment in AI servers and data centers. So that's all good. And of course, the overhang is that the recent court case in the US basically kind of said that Google was a monopoly in some segments. So apart from that, a really good set of numbers from Alphabet, and I guess that's also a bellwether for the whole AI industry. So if Alphabet says that they're running out of data servers for AI and they're going to be spending more, so it'll be interesting to see what happens to NVIDIA as well as Meta and so on and so forth.
Yeah, I suppose a lot more to watch. If I'm not wrong, Meta, Microsoft, Qualcomm, if I'm not wrong, also next week, right, reporting earnings there. So lots to watch indeed, and we shall keep our eyes on corporate earnings out of the US. Thanks so much for the insights, Ben, as always. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.